Good morning, good afternoon, good evening, everyone, and welcome back to the breakfast show. We have the first big earnings report of this season, unless you are interested in banks, because they also reported. But TSM reported before the market opens. Stock is up, the whole semiconductor segment basket is up as well. So we'll touch on that in this video. We'll look at some banks as well. Quick summary of what they have reported also before the market opened. Then we'll have a listen to an analyst that talks about the software names, because the software basket has been completely crushed over the past 12 months. Every big software name that you can think of is basically down substantially over the last 12 months. Now, all of them continue to grow. I think most of them, if not all of them, are quite profitable. They've become quite cheap. Now, as you know, low can go lower and cheap can become cheaper. And the question here is, when will the market figure out who's a winner and who's a loser? We've talked about Salesforce, we've talked about Adobe before, talked about various software plays. The market currently is still in the same camp, and that's the camp of AI is going to eat software. Previously it was software is going to eat the world, and now AI is going to eat software. Whether you believe that or not, that is up to you. Do let me know in the comments if you've been buying some software names. Maybe you hold some software names. Maybe you're a bag holder. Your back hurts. Let me know in the chat. That last comment here, Conor Gallagher. We shall not talk about that. Anyways, the morning, the pre-market action is pretty good. Pretty good all in all for the tech names. We are seeing some green across the board. If we look at our semiconductor basket here, all of them are green right now. All of them are green. Lam Research, well, the equipment makers are the ones that are up the most. You will see why. Lam Research is up 8%. Applied Material is up close to 8%, 7.7. ASML is up 7.2. CLAC is up 6.7, TSM is up 5.5, then we have Micron up 3.5, AMD 2.7, Broadcom 2.6, Marvell 1.6, Qualcomm 1.4, Nvidia 4 as well, and Intel is up 0.6%. Now, why is that? Well, pretty simple. It's because TSM reported its quarterly figures. We'll go into the slides in a bit, but this is basically the highlights, beats across the board. Beat on revenue, gross margin, operating margin, net profit. Then as for fiscal 26 capex mix, that is also increasing quite substantially. So $52 to $56 billion versus $40.9 billion in fiscal year 25. And the estimates were $48 billion. So quite higher. And TSM is one of those companies where if they are increasing capex by that much, this means there is quite a lot of demand. They're usually the ones that are quite conservative out there. And so if they are seeing the need to increase capex by that much, then there is definitely a lot of demand. Because think about it, TSM is not the company that is going to say, okay, you know what, we're going to talk to a couple of companies. They will tell us that they see demand for the next 12 months. And so that's why we're going to increase our capex by $12, $14 billion or so year over year? No, because what happens after 12 months, right? TSM is building fabs. Fabs, they cost quite a lot of money. So they don't want to be in a situation where in 2 years' time, well, suddenly their fabs are not running at full capacity, their margins are plummeting. So if they are increasing this means that there is definitely enough demand for the next coming years. And we've got some more comments on that we'll go over. As for Q1 guidance, also beats across the board for revenue, gross margin, operating margins. Now, if we go and have a look at the slides for TSM, we'll pull this one up right here. So this is basically what we've gone over right now. Their guidance, they beat their own guidance. They beat the guidance from, well, the expectations from Wall Street, but they beat their own guidance as well. So all of that is good. If we look at the revenue by technology, so what we have, 28% comes from 3 nanometer nodes, 35%, still the majority here, comes from 5 nanometers, and then still 14 from 7, which has been, as you can see, it's the blue bar right here, it's been flat-ish. 5 nanometers, of course, has been increasing, and the same for 3 nanometers, although the growth there has been quite stable. It's not like 3 nanometers is dominating this pie right now. And again, I'll repeat the same thing again and again. This is the magic of a foundry. Even older nodes are still generating money for the company. Then, if we look at the comparison, 25 to 24, in 24, 18% came from 3 nanometers. Now that's 24%. 5 nanometers has basically been flat. Same here for 7, went from 17% to now 14%. As for revenue by platform, surprising, not really. 55% HPC, and that grew only 4%, well, only 4% quarter over quarter. Smartphone is up 11% quarter over quarter. IoT 3, automotive is down 1%. DCE is down 22%, but that's just 1% of the pie right here. Smartphones, 32% of overall revenue, while HPC still dominates here at 55%. This was for the quarter, and this is for 2025. Huge growth, of course, in HPC. Even smartphone was lagging. Smartphone was still up 11%, IoT 15%, automotive up 34%. And again, the overall pie here, 58% is HPC, 29% is smartphone. As for the rest here, we can go over the comments right here. Let's see if we can zoom in on that. I do wish we could have pushed this a little bit more to the left, so the key takeaways become a little bit bigger there. Let's focus on long-term revenue. So that's underpinned by technology differentiation and a broader customer base. Tsmc now expects its overall long-term revenue growth to approach a 25% CAGR in US dollar terms. By the way, I think it's the first time where it crossed 1 trillion new Taiwanese dollar for the business. So long-term revenue growth to approach a 25% CAGR in US dollar terms for the 5-year period starting from 2024. So you still have a couple of years left. Truly amazing performance. Then they gave us some updates on the fab in Arizona, the one in Japan, Germany, Taiwan, all going according to plan. I do wonder if they told us a little bit more. Okay, so long-term profitability targets. TSMC aims for long-term gross margins of 56% and higher, which is lower than where we're at right now, through the cycle, and a return on equity of high 20s through the cycle, despite increasing manufacturing costs and overseas expansion. Still very, very good. Expected dilution from overseas fabs will be 2 to 3% in early stages, widening to 3 to 4% in later stages. The initial ramp up of 2 nanometer technology is expected to dilute gross margin by 2 to 3% for the full year 2026. Customers indicated that silicon supply from TSMC is currently the bottleneck for AI infrastructure build-out, not power electricity supply, which they planned for years ago. Okay, again, this is also something good, because this means that as TSMC ramps up, all of these companies can get to work and start generating way more revenue, which again, it's not power electricity supply. So every time we hear about, energy, electricity, all of that, I guess that's not an issue at the moment. As for the competition, TSMC acknowledges formidable competitors but expresses confidence in maintaining its leadership due to complexity of advanced technology, long design and ramp cycle, and continuous innovation. Talking here about Intel and Samsung, I assume. Pricing remains strategic, not opportunistic. While new nodes command higher prices, the benefits primarily cover inflation cost. High utilization rates and manufacturing excellence, productivity gains, cross-node capacity optimization are key drivers of profitability. And so, all in all, I mean, if you are a holder of TSMC, I think you can be quite pleased with the performance this quarter. Over the past 5 years. TSMC stock is up over 161% over the past 3 years. It's up now 267% over the past 12 months. That's 58% return. And year to date, well, it's already in green, just like the majority of these names. But if you look at an ASML, for example, you can buy it in euros and in dollars, in case you didn't know. ASML, if you look at the lows of, I'm not even talking about the April lows of 2025, because again, the April lows is a one-time thing. But if you look at the lows here in August of 2025, stock is up, stock is up 63.6%. That's a euro one. If you look at the NASDAQ, I think it doubled. Let's see. Did it double? I think it's going to probably be up 100% or close to it when we open. From August until now, ASML, a company like ASML, $500 billion in market cap, has doubled. And this one is up 139% over the past 5 years. And now it's probably going to be up 100% over the past 3 years. Of course, why are the equipment makers up? Well, we've just heard what TSM had to say. If they are expanding, if they are seeing so much demand, well, every fab is going to need more and more equipment. Getting those equipments, those things from the likes of ASML, if they are seeing so much demand, then that means that Lam Research, Applied Materials, and all of that, they're also going to experience an increase in demand. And so if we go and look at our stocks right now, where is it? ASML is, well, here. What is it? Oh, yeah, all-time highs by far. So we've seen actually over the last couple of weeks that equipment makers have started to run up right across the board. Lam Research, Applied Material, ASML, CLAC, they've all, basically it's the same thing. It's the same pattern across the board. Literally the same pattern. As for TSM, this one is just a steady compounder. Goes up and to the right. Incredible stuff. YouTube influencers trash about TSM. I don't know who, honestly, I haven't seen one bearish video on TSM or ASML, but pretty sure some people talk trash about it because it didn't perform for like a month or two. But yeah, two tremendous companies. Any reason why PayPal was up yesterday? Because the market was down. So It's like market down, PayPal up. It's very easy. Time to take profits on ASML? I don't think so. I mean, unless you wanted to trade this and you're up, I mean, you basically doubled your money, and that's good enough, then yeah, why not, right? Why not? My thoughts on Netflix? Well, I am now a Netflix shareholder, so. No bearish video on TSM. Watch any. I mean, yeah, that is the bear thesis, right? That's the bear thesis. It's geopolitical stuff. But then again, it's not just TSM that's going to get hit. It's the whole portfolio, right? No matter what we're going to own, it's going to go down. Any thoughts on if I prefer not to speak. If I speak, I'm in big trouble. Big trouble. The local updates, well, we do actually have a little update, but remind me of this after we're done with the review. So all in all, TSM, every semiconductor is up thanks to that. Every neo cloud players is up as well. If you look at CoreWeave, CoreWeave is back above $90 before the market opens. It's up 4.8%. Nebius is above $100 actually. It's up 200. It's up 2.5% pre-market. Core Scientific 2.2. Same for Applied Digital. Iron's up 1.5%. Cypher is up 1.3. Hut 8.6, and the same for White Fiber. Although White Fiber yesterday was up 13%. Interesting. Why was that? Did you announce a new deal or something? New contract, new deal. Let's see if we can find something. WYFI. Yesterday. Now we got an. Is it maybe because of OpenAI and Cerebras partnership? Because apparently Cerebras is a White Fiber customer. That's what I'm seeing here. What else? White Fiber themselves did post something. MTL3 has been fully operational since Q4 25. Something. Okay, maybe it's because of the OpenAI. Maybe it's because of the OpenAI stuff. Now, that is not all, ladies and gents. So there were some rumors circulating yesterday about ClickHouse. So let's actually pull this one up. So yesterday there were some rumors circulating about ClickHouse and the recent raise. So apparently they're raising capital at a $15 billion valuation. That's up from $6.35 billion less than 8 months ago. Now, the last time we heard about how much Nebius owns of ClickHouse, that was 28%. It did participate in that last round, obviously. But yeah, I agree here with Manuel. I do think that they don't own 28% anymore. Remains to be seen how much they still own from it. Yeah, but if it is above 20% and ClickHouse is valued at $15 billion right now, I think, I mean, we speculated before that ClickHouse is going to go public over the next 2 years or so. If they go public at, I would assume if now they're getting a $15 billion valuation, they'll go public maybe 26, let's say 27. Wouldn't be too crazy if that valuation has doubled, right? And so if it has doubled, I guess Netflix, Nebius could have, what is it, $6 billion in it. That's quite substantial, but right now those are just reports and, well, rumors, I would say. Let's report unconfirmed. But yeah, still very happy with my Nebius allocation. Still have a long way to go. Then, but since I'm already here, let's quickly touch on the local stuff. So there was a meetup, a conference, I assume today or probably yesterday. So Manuel here with the key insights. Pedro does not expect a meaningful deceleration in TPV growth in 2026. We are growing above 50% 2025. He said we still manage the business to try to sustain very high levels of TPV growth in line with what we saw in 2025. If we can get another 50% growth year for TPV, insane. Then they are prioritizing expanding the buy now pay later solution. The company may disclose the size and take rate of the buy now pay later business towards the end of the year, provided it reaches significant scale. And then the last one is doubling down on Asia. Management aims to increase Asia's share of the local TPV from the current single digits to at least 30% over the next 3 to 5 years. We've talked about Asia, Southeast Asia when talking about C Limited, when talking about Grab. Emerging markets, their GDP is expected to grow much, much faster than Europe and North America. And so if the local can position itself quite well in those markets, wouldn't be too crazy to see them go from single digits share to 30% of their own TPV over the next 3 to 5 years. As for the Venezuela stance here, they're assessing the local payment landscape and gauging interest from potential clients. However, entry would require sufficient customer demand and an easing of US sanction. It's not just the local thing. I assume it's also Mercado Libre, new holdings, a lot of that. They're just waiting to see what the heck is going to happen with that situation. But to me, the local is still, yes, a potential multi-bagger and in my opinion, still quite cheap. It's usually always at the same time, and if I'm not streaming, then I'm not streaming. But I know over the past 2 weeks or so, again, I've been, consistently tired, and so I decided to just take a break. Didn't even work out for the last 2 weeks or so, like went for walks and stuff, but I don't know. Too tired. I am still taking vitamin C, vitamin D, so hopefully should help as we approach the earnings season. Then what else did we say? The fintech sector. All right, fintech sector. This pre-market we have Hood. We have barely 4 names that are down 0.1 to 0.4%. All the rest are green. Dave is up 2%, but as you can see, Dave has been getting crushed over the past couple of days. Well, actually, since the credit card 10% cap thing came out, so that's down 26%, which is quite strange because I don't really see how that's going to impact Dave. But okay, again, the market shoots and then asks questions later. It's down 26% in a matter of 3 days, and I don't think that the business has changed that much. As for Nu, that is also down. How much exactly? Well, now with the pre-market, it's down 8%. So we're back here in the $16 for Nu. Little rebound here on the 50-day moving average. As for the rest, they are up less than 1%. Yesterday, PayPal was actually up close to 2%. Believe it or not. Believe it or not. Crazy thing to see. Moving on to the big tech players. We have Apple that's up 0.1%. Apple has been touching and around that 100-day moving average for the last week or so. Then we have Netflix, still just under $90. I am now a small shareholder of the company. They will report their quarterly figures Tuesday after the market closes. Of course, we're going to cover that. Tesla, still here, $440. Meta, this one is, quite crazy. Meta is up pre-market, but not by much. All of them are up barely. Amazon and Oracle are up 1% or so. Meta has been, it's not as low as before. Could it get back to the 580s? Maybe. I did draw this magical uptrend line that started November 2022. So if it were to touch it, it would be around $605 or so. But yeah, I did add, I think, 3 shares of Meta yesterday. I already own a lot of it, but then again, if you're going to present great opportunities, then I will take it. I'll take that. Microsoft is also one that I did say that maybe I'm also at fault here for not covering this one that much. This one is down 17% or so from the all-time highs. Okay, from the all-time highs. Maybe it should have never been at all-time highs. Who knows? But Microsoft is, yeah, it's an interesting one here. It's a bit in no man's land. It is reporting 2 weeks from now. Yeah. Wait, what day are we? 15. Okay, so yeah, let's call it 2 weeks from now. $462. Maybe it's worth revisiting. As for our biggest W here in the big tech sector, Google Alphabet continues to make all-time highs, $337 pre-market. We have Oracle that's still floating and flirting here with the $190, $200. And then we have the painful Amazon. Sometimes we think, okay, finally the market will push it towards $300, but nope, it does not, which is fine for people that want to accumulate more and more. You just laughed out loud for my Pokemon cards? I mean, yes. For those that don't know what I'm talking about, let me show you what I found yesterday in my collection. First of all, look at this masterpiece. We got this before GTA 6, Grand Theft Auto Silicon Valley, Sundar and Demis. I mean, when this picture came out, it was over for everyone else. But I do like this cover. I made this myself with my buddy Gemini. But this is basically what he's talking about. I found this rare card yesterday in my collection. I don't know if it's worth something. Some people say it's worth $0. Others will say it's worth $100. We'll see. But I'm keeping this. Maybe I'm sending this to PSA for grading. What's wrong with Rocket Lab? Is it going bankrupt? Is Rocket Lab going bankrupt? I don't know. After a 20x $45 billion company, is it going bankrupt? Probably not. Probably not. Could we have a pullback? We could. I mean, I did take some profits earlier in the week. It did continue to go up, which is fine because the majority of my position still exists. So I'm quite happy with that. But is it going bankrupt? I don't think so. Now, one strange thing that happened this morning, apparently, and that's BMR related. So apparently, Tom Lee and BitMine decided it was a good idea to invest, $200 million into Mr. Beast's thing. So apparently, BitMine says it's making a $200 million equity investment in Mr. Beast's Industries, expected to close January 19, 2026. BMR says the teams may explore DeFi features for Beast planned financial services platform. What? I don't know. Maybe in hindsight we will say there were signs of a top, but like why would you do this? To me, it doesn't make any sense. And what is this Mr. Beast financial services platform? Who are his customers? Like 5 years old and 10-year-old? That doesn't make any sense. Doesn't make any sense. Like why don't you just continue to buy ETH, pay a better dividend, or just buy maybe shares of BMR? I don't know. I don't know. And like Max Verstappen said, I don't know and I don't care. but I know some of you do, so here it is. Moving on. Moving on to the next thing, what is red? As you know, software names. Software names completely crushed. So Adobe, even lower than before. Adobe is back to levels not seen since November 2022, which was the bottom for the overall market. Salesforce probably also, no, okay, Salesforce, but it did come down. Still at around $240. I think ServiceNow is also, I mean, we've looked at ServiceNow a little bit. ServiceNow is also now same level as the April lows of last year of June 2024. So here also a crazy pullback for ServiceNow. Where is Snow? Ah, okay, ça va encore. It's okay. So 26% pullback, okay, but from the peak in October, probably overvalued back then, but still interesting. Let's see. Grab, I did touch on Grab. No, I did touch on Grab. I think to start the year, I touched on Grab. A little reality check for those that wanted it, but yeah, it is still around the same levels. I mean, we've been well above it in September. Is it now a 30% worse company than it was before? Probably not, right? Probably not. What is holding in this back? I don't know. Is it put in the same basket as Chinese stocks? No, because if we look at Alibaba, Alibaba has seen a little recovery over the past couple of weeks. Alibaba is very cheap also. So I don't know. I don't know what's holding Grab back here because they are performing well, as we've discussed before. But it seems like the market likes to put this one at around $5 for quite a long time, although now we're at $4.6. But yeah, definitely it got a lot more attention before than right now. But Transmedics, indeed. Transmedics is indeed, well, yesterday it was. I think because the CEO shared some news. But yeah, Transmedics, I mean, we've covered Transmedics late last year, especially when it came down quite a lot. Didn't make much sense. It's one of those very small companies, potential multi-baggers as well, growing quite rapidly. And yeah, as you can see, it is making its way back up. I wouldn't be surprised if it continues. Would not be surprised at all here. Thoughts on Bloom Energy? Did I write it down? I did write it down on paper, but I never really had the chance to properly look at it. It seems like they're involved in a lot of deals over the past maybe 12 months or so, but I have not really looked at it to form an opinion. I have too many companies to focus on right now that are trading at pretty good levels. Uber is one, Meta is one, and then yeah, all the rest, the Shift4s, the Rubrics. Well, what did Rubrik do yesterday? Of course, it was down. Yeah, 3.7%. I don't know here as well with Rubrik what the market is expecting from this company. What has CrowdStrike done? Is it also down? Yeah, but I do feel like CrowdStrike is an amazing company, but it's a bit more expensive, I think, than in my eyes, than Rubrik. What's the drawdown since November? 17%. Rubrik is way more than that. Yeah, 26% drawdown right now after a triple beat, like double beat for a quarter, and guidance was raised. I said it before, it's like the Duolingo stuff, although I just don't see what the negative pressure on Rubrik. But hey, maybe this gives me just opportunities to buy more. Shift 4, I think since we've got that info that suddenly the broken clock, Michael Burry said that, oh, he's not a fan of Shift 4 anymore, the stock did start to go up a little bit. Am I surprised? Nope, I'm not. Not at all. Duolingo continues to go down. So now we're back to the August 2024 levels. Back to the August 2024 levels. Let's actually have a look at a couple of pricing metrics here for the Duo. $8.2 billion in market cap. The trailing PE is very low, but that's because just of a one-time thing, which is also why the net profit margins are at 40%, should be closer to 17, which is still fine. And that's why the forward PE is at 51 times. But if you look at price to free cash flow, which I do think for this business is a better metric, sits at 21 times. 21 times, revenue forward 2 years still 30%, EPS 51.4%. We did have the preliminary results, which showed around 30% growth for daily active users, and bookings actually beating or slightly meeting the high end of the guidance, which is also pretty good. But I am still waiting to hear more on the earnings call, and especially looking at margins for the business. But it's definitely a company that has become much cheaper than before. If we go and look at the ratios, let's look at this. So that's trailing price to free cash flow. That's a bit too much. Let's do this. So yeah, price to free cash flow is at 20.6 times. Of course, when you were trading at 81 times, okay. I mean, when you're growing very, very fast, I guess you deserve to get this type of premium for a short term. But yeah, this was bound to correct. And I think now at 20.6 times is a much better price. Of course, I'm saying this as one of the bag holders of Duolingo right now. But yeah, makes a lot more sense here. Unless, of course, the business does deteriorate from here on out, which so far I don't think we can conclude that that's the case. I know some people are fans, some people say it's garbage, etc., etc. Fine, everybody's entitled to their own opinion. Wait, forward price to free cash flow is now actually a bit lower than 16.3. That's quite low. That's quite low. But yeah, so far, I don't think the thesis has been broken. It's just that too many question marks, I guess, around what's going on with the business, the changes that they're making, and etc., etc. I mean, to still have 50 million daily active users is quite an achievement for a learning app. Again, I know you're not really learning that much. I know I've made this case before that you can put this in the gaming, in the gaming category, in the learning gaming category, and that's fine, right? At the end of the day, if it's purely a learning app or learning/gaming app or whatever, doesn't really matter. What matters is to see this number go up, right? The daily active users, to see this number go up, and to also see that subscription revenue goes up and to the right, which last quarter was still growing, 45.6%, still pretty good. And you also want to see paid subscribers continue to go up, especially the ratio paid subscribers to the overall one. So if you look at this, this is also a pretty good picture. Daily active users go up, and what do we see here? Paid subscription penetration, 8.5%. A couple of years ago, this was at 5-6%. If this can continue to go up to 10%, then yeah, I think the investment is definitely worth it. But as you know, if you don't like it, just don't invest in it. Simple. Very, very simple. Plus, yeah, I think chess has been an amazing launch for them. Amazing launch for them, especially now that you can play against other players. It's very good. I am now, I think, at a 160-day streak or something like that. Not with chess, just math. I like to do stupid math problems. But maybe I have to look at the chess one. Mbappe here. I mean, Mbappe, me, Bruno Fernandes, we are switching from football to stocks for a reason, right? Real Madrid sucks, which makes sense because they're not really a team. They're just a collective of egos. But my conviction in Root or Adobe is, look, it's two completely different companies, right? Adobe is just dirt cheap. Valuation-wise, doesn't make any sense. but then again, it hasn't made sense for quite a while, right? It's still growing 10% or so year over year. Margins are amazing. And so I'd say it's a safer bet, right? Because it is dirt cheap. Root is a potential multi-bagger purely because it's worth $1 billion, operating in a huge market, growing, profitable, right? The year to date, the 2025 year, if you look at that, it's profitable. So if you're looking at multi-bagger potential, I would say Root. If you're looking at picking a name that's just purely undervalued and you beat the market just because the market will eventually notice that some of these software names are just stupid cheap, then I guess there is that. There is Adobe. Do I play chess on Duolingo? I do not play chess. Do I play chess in general? I played chess. I played chess with my grandfather actually every weekend, but unfortunately that is not the case anymore. But yeah, I haven't played chess in a long time. But yeah, maybe I should try it out again. Although I prefer to play chess with physical stuff than on my phone. I don't know. I just like to. Anyways, what else? What do we need to look at right now? Oscar, where is it? Still here. That's fine. Apparently they'll report Tuesday, February 10th, before the market opens. Okay, so Tuesday, February 10th, we have Oscar. Pagaya, we have Monday, so the day before the market opens. I think the local, we still have a long time to go. This should have been confirmed already. PayPal is February 3rd, before the market opens. Do we have an Uber confirmation? Wednesday, okay, so the day after PayPal. Okay, this is going to be a hectic week, I think. Meta is still unconfirmed. Intel is next week, I assume. Yes, on Thursday next week. Palantir is a Monday. Yeah, Monday, February 2nd. It's always on Monday. Alphabet is also same day as Uber, one day after PayPal. I think that week will be a make or break week for moi. No, I don't own any ETFs. I do not. Why? Because as you know, I am a stock picking genius. No, I am just a couch investor. I just like to pick stocks. That's it. Eventually, probably I will buy ETFs when I'll just be chilling on my couch wherever, and I don't want to focus on specific names. Then I'll probably do that for sure. I mean, it's 100% what I'll do in the future. Lichess is the best chess platform. I guess according to you. Other people will probably say chess.com is the best platform. But like I said, I like to play on a board. When I was in New York a couple of days ago, I was just walking around in the park there and looking at a couple of folks in the park play chess. Quite entertaining. Who else did confirm their quarterly figures? The date. Okay. So Tuesday, February 3rd, we also have AMD. Whew. That is going to be, yeah, so AMD, PayPal, Uber, Alphabet are all reporting the same week, Tuesday and Wednesday. The impact on my portfolio is not going to be small. Not small at all. And SoFi is end of January, as you know, Friday before the market opened. That's, I don't know. That was very strange. And maybe they'll announce something. I don't know, but it is was peculiar stuff. The green markets today is purely, I would say it's because we have Tsmc that reported very good figures. So AI and semiconductor names are green, and since they dominate the market, so I guess that's why. I must have a number in mind. I don't know. Big number, I guess. Big, lots of zeros. I don't know. It also, I guess it also depends at what age you reach that magical number, but I don't know. Like, if you tell me what's the number I'd like to retire today, I don't know. That's actually a good question for everyone. What's the number to retire? Like, to retire today? If I can snap my fingers, you get that number into your bank account and you are retired. I'd say, I think 5 million. 5 million is enough. Because you can buy a house, you can send everyone to 1 million today. I mean, not an extra million on your bank account. Like, this is the number you have. So what do we have here? We have a couple of million. 1 million, 1 million. Adam from, okay, but Adam, you're in Vegas, so I assume 8 million. You'll take a couple of million, put on red, put on on black, and see if we can turn that 8 into 16. 5 million, 1 million, another million. What is this? Also 5 million. Yep. 3. You will never retire. I mean, officially you can say retire, you just don't have to be a couch potato, right? You can just do whatever you want. If you wanted to do, I don't know, whatever, you can do it without having to think about the money. 2.5, 500,000. Okay. 2 million euros. Smart. You use euros instead of dollars. Too much focus on gaining money, you can't spend it. Well, I can think of various ways how you can spend $5 million today if you wanted to. With 1 million, you can live comfortably from the dividend alone. No. Because let's say you find a 10% somewhere. You're not really getting 10% because you're getting taxed. So it's less. It's much less than 10% actually. And I don't think it's enough, especially if you have a family and all of that. And because remember, you cannot work in this hypothetical scenario. And if you plan on using the money, then the overall money does come down. 15 million. 5 million is not bad, but on those 5, you have to let some working to keep. I mean, again, the 5 million is, with the 5 million, it's because you will probably be able to put 2 million aside in probably in high dividend asset and live off that, while still have 3 million, probably a million or so, maybe a little bit more, probably a million. Like buy a nice place, maybe 2 nice places, and do whatever you want. And all the rest, various investments and earn money out of that. 1 million is probably, which is crazy to say, is probably not enough. I mean, unless you are, I mean, I'm 31, so probably not enough. That's for sure. Or yeah, you could take the 1 million and go to Thailand, or, I mean, even Japan. Always go back to Japan and live like a king. That is true. That is true. Now, before the market opens, I do want us to listen to to an analyst we do like, actually, from D.A. Davidson, talking about the software names.
Not everyone is a seller of software. Our next guest sees bargains in the space and says the AI scare narrative is not tied to reality. Gil Loria is the head of technology research at D.A. Davidson and is out with a note today on software valuations. Gil, great to have you with us. I take it that you heard Carter's analysis of the space. It's not a very rosy picture in terms of performance past or performance future. So why do you think this group, what are the fundamentals that will drive this group higher when they've seen such underperformance for the past 5 years?
Yeah, the simple reality that software businesses are still the best type of businesses. They are recurring revenue businesses that scale well at very high incremental margins. None of that has changed. The good news is we used to talk about software companies a multiple of revenue, and who can really tell the difference between 6 times revenue or 8 times revenue? We don't have to do that anymore. We have great software business growing double digits, 20% and higher, that are now trading in the teens on cash flow, on the 20s on cash flow. Those are attractive price points. And we don't have to fight Carter's charts. We're not calling a bottom on all of software. We're just being selective about the stocks that are doing so well, the companies that are doing so well, and their stocks keep going down every day, that we believe that if we continue to buy those, there will be a re-rating once this wave of negativity is over. Because again, there has been no AI impact on any of these companies. AI has not disrupted or dislocated any software company. And if it doesn't do it this year, at some point we're going to scratch our heads and say, isn't AI just a disruptive technology that good companies are going to adapt well to, and bad companies are not going to adapt well to? So if we buy the good ones, they're going to do well.
All right, Gil, so Adobe made its all-time high in, I think, the fall of 2021. Think about that for a second and think what the market's done in the meantime. And we're trading the levels that we last saw in the fall of 2022. What's the bull case here, other than the fact that technically we're hitting what should be support, and you can make a decent case on valuation?
So the bull case on Adobe is, for all of the negativity around AI, Adobe's growth has actually held up better than the overall software universe. Their growth has decelerated from maybe 12% to 11% or 10% over the last 3 years, which is to say that really strong recurring revenue business that's embedded in every marketing organization and every agency has held up really well. And to your point, the stock has not. It's now trading at low teens multiples on earnings and cash flow. If they just keep doing what they're doing, which is grow 10% this year, then it's not going to be sustainable that their stock will continue to be this inexpensive. Which isn't to call for a catalyst here. They're just going to keep doing what they're doing. It's the narrative that's been very negative about Adobe, again, without evidence. They haven't lost any business to AI, nor does it look like they're going to lose business to AI this year.
What's your take on the Oracle, the bondholder?
Before they continue to talk about the Oracle stuff, let's actually have a look. I've put here Salesforce, ServiceNow, and Adobe as I think the 3 big software names in questions here. So we have here forward free cash flow yield. The number 1 here, the big increase you can see, 8%. That's Adobe. Salesforce is at 6.6%, and ServiceNow is at 3.6% right now. Forward price to free cash flow, ServiceNow is the most expensive at 27.7%. Then we have 27.6 times, 15 times forward price to free cash flow for Salesforce, and 12.4 times for Adobe. Now, ServiceNow does deserve a premium because it is growing faster than an Adobe and a Salesforce. But I agree with him. I agree and I disagree. I agree with him that yes, all of these names are quite cheap. And again, if they continue to do what they are doing, which is grow 10%, then again, eventually the market will have to notice. But we've seen that before. Why didn't they notice last year? Why aren't they noticing that for Salesforce? Why aren't they noticing that for PayPal, for example? Maybe it takes longer than a year for the market to notice. I don't know. But in the meantime, in the meantime, I guess you can keep on accumulating shares or stay on the sidelines and see if you suddenly have a positive reaction from the market. Lastly here, before we go and open the market, I think we still have 4 minutes, the Oracle stuff.
There's lawsuit. What's your take on the Oracle, the bondholders lawsuit with Oracle? They allege that, there might have been malfeasance. Maybe there should have been more disclosure at the very least because they bought these bonds in September and then several weeks later, Oracle went out to raise another $38 billion and they feel cheated. Is this going to be an overhang as companies go again and again to the debt market to finance?
Yeah, Oracle overextended itself for OpenAI. OpenAI promised them the moon, and then Oracle realized that OpenAI actually had promised everybody else the moon as well. And then they overborrowed to build infrastructure. They're now at the very bottom. They're approaching the bottom rungs of investment grade. They're approaching the ceiling of debt ratio, and yet they need to borrow more in order to deliver on these commitments. So they've put themselves in a real bind. The stock's gone down a lot. Their debt is trading at a discount. And it's not too surprising that recent debt holders feel like this isn't what they bargained for when they bought the bonds a few months ago.
Which leads me to the Oracle stuff here. Oracle is now trading at a trailing PE of 36.8 times and a forward one of 26.7 times. Now, of course, with Oracle, I mean, like he said, OpenAI did promise the moon to various companies. Some companies, they'll do well with or without OpenAI. Oracle is a bit different. But Oracle is still expected to grow 20% compounded for the next 2 years, earnings and revenue. I mean, if they do achieve it, then I guess that's fine. If they don't, this is a company that doesn't really generate any free cash flow at the moment, right? Free cash flow is negative here. Then there is an issue. It's great to have a huge RPO, but eventually you'll have to recognize it, and for their sake, they'll have to recognize it quite quickly. And when you think about it, why own Oracle when you can own a CoreWeave, a Nebius, these types of names, right? Question. All right, we're going to open the market in a couple of seconds. Bum, bum, bum. Let me get my little asset here. All right, ladies and gentlemen, the markets are open. Ding, 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 bing, bing, bong, bing, bong. The markets are open. We are Thursday, January 15. It seems like we are going to have a green day after a red day on Wednesday. I had to make sure we are really January 15. It is indeed. So we see some green across the board. There is some red, as always. There is always going to be some red, but hopefully we do get more green than red. Let's give it a couple of seconds. Of course, we are seeing our dear PayPal be okay. It's flirting here. It is teasing us a little bit. Green and red, undecided. Although if we are going to have a green day, then I guess PayPal is going to be red. But let's see. Let's give it a couple of seconds to see what we are going to get overall. Let's start already here. Look at the fintech players. Most of them are green. Those that are red are barely red. I mean, it's PayPal basically. It's PayPal who's red. Bull is down 0.7. Hood 1%. Block 0.7. Pagaya is down 1.2%. Klarna is up almost 2. Adyen 1.6. dLocal 1.4. New 1. Affirm almost 1. Chime 0.5. Shift 4 close to it. SoFi is up 0.8. American Express 0.3. Visa 0.5, and the same for MasterCard. If we look at, very nice. If we look at CoreWeave, the NeoClouds, CoreWeave is up 8.2%, Nebius 2.7, Iron 0.7, Hut 0.3, Core Scientific is flat. Very good. We need CoreWeave to completely obliterate the performance of Core Scientific. They're flat. Applied Digital 0.2, Cypher down 0.8, White Fiber down 7.8, but they were up 13% yesterday. So yeah, that's what you get. As for the semiconductor players, same thing as pre-market, everything's green. The equipment makers are up the most, and all the rest is up 1% to 2%, 3% or so. Nvidia is up almost 2%. As for big tech, we have Alphabet that's basically flat to red. Apple is up 0.2, same for Oracle. Meta is up 0.4, Amazon 0.6, Tesla 0.8, Microsoft 0.6, and Netflix is up 1.1%. Crypto, Bitcoin 96,700, ETH 3.3, Solana 145, and Ripple $2.11. As for our general list, we have We have Rocket Lab that's down 4%. Ooh, the horror. Novo Nordisk down 2.5, Pagaya 2.7, Reddit 2.1, AST 1.8, Grab still down 1.1, BMR 1.3, Alibaba is down 1%, United Health around the same, Salesforce 0.4, HIMS is down 0.3, still around $30. Root is down 0.2. Adobe 0.1, Oscar is up 0.5, Zeta is up 0.3, still around $22. Where is Melly? Melly is here, up 1.8. Okay. Overall, still pretty good. Palantir, where is it? Here, Palantir still, yeah, I mean, it hasn't really moved much from the $180. I am waiting for... Okay, he will come soon enough. Banks. Okay, so first of all, let's actually... Morgan Stanley reported. So beats across the board. Beats for net revenue, EPS, provision for credit losses, those beats. Commentary, investment banking activity accelerated, and client assets in Wealth Plus, I assume it's investment management, grew to $9.3 trillion. That's crazy. So that was Morgan Stanley. We'll have a look at what they're doing in a bit. Goldman beat on EPS, did miss on revenue. Lower than the fourth quarter of 2024 and 11% lower than the third quarter. Okay, no reason we're given here. Partially offset by significantly lower net revenue in platform solutions tied to the Apple Card loan transfer contract items. So Goldman reported, we'll see about that. BlackRock also beats across the board. EPS, well, adjusted EPS, revenue, assets under management, 14 trillion. Oh, crazy. So they're seeing accelerated momentum, strongest year and quarter of net inflow in their history. They have a goal of $400 billion in private market fundraising by 2030. So, guys, if you have any ideas, you know what to do. Let's see. Goldman is up 0.6 right now. Morgan Stanley is up 3.4. BlackRock is up 5.1. Wow. Okay. And JP Morgan did report earlier this week, and they are up a little bit, but they were down 4% on Tuesday. Okay. Why are we laughing about PayPal? Because it's red. Of course. When was the last time we had here? We did have this. All right. Ladies and gents, we will have a look at a pretty boring but strong company. And that's a company with 4 letters. It's called FICO, or Fair Isaac Corporation. Deployment unavailable. What is this? Why is that? Because we have here again our special expert in the field.
Hey,
Emir, how
damn,
are you?
You were fast. I just joined. I heard you switch topic immediately. That was quick. Yeah,
Professional
I just had a
stuff
call, and just prior to this, I just jumped in. Sorry if I'm late. But yeah, here we are. A few days ago, I forgot when it was, probably last week. Shared, 3 ideas, good ideas for 2026. Actually, right after that, I finished a research piece on FICO, and I think this one might actually, top some of those companies on that list, because this is pretty amazing what I've been finding here. And no one really talks about FICO, so
Other than you.
I don't even talk about. I had some guy, comment on my YouTube channel. He's like, "Dude, you posted this video like a year and a half ago. When's the update coming?" I'm like, "Oh, right. I should post an update." Yeah. It's F1 guy. Oh my god. I thought my identity was the Palantir guy. Okay.
Yeah, maybe.
I can hear an echo. Do you have headphones, or are you using speakers? FICO. Palantir guy is Amit? Yeah, that's true. Amit. Hello? Oh, we broke the audio. I was complaining.
No, wait. Let's see if we can make this work. Because when I talk with myself, I don't really have headphones on, because why would I?
Yeah, makes sense. Well, I do for some reason. I always, feels
okay. Should be good.
All right. Should we just get into it? I won't take long. I want to go sleep, so it's about to be 12 p.m. here. So
we could get into it. I hope you don't have to use Fiscal, because I think the website is down. Oh no, it's wait.
Who do you think I am? I have my own Fiscal. Yeah, get out of here.
To use my link, guys. Anyways, yeah, we can go look at your presentation.
All right. So many people might not be familiar with, FICO, the stock, but most people in the US are familiar with FICO, the company, or more specifically, a FICO score. The whole concept of a FICO score might be familiar to you. And maybe you'll be surprised to know that this, in my opinion, is the most unfair business model in the whole world. Like this is not even, I can't even think of a comparable business that is as, undisruptable with the same pricing power as FICO. And people often, they talk about it as like a compounding machine. Well, what does that look like? Well, it looks something like this. I'm sharing screen. So this is EPS growth from 2019 until 2025. This is 27% CAGR, and that comes from their sheer pricing power. And if we, put it into numbers, since that year, they have grown, the prices for their services by 725%. That is like unparalleled pricing power. I dare you to find me a company in the market that has increased their prices by 725%. However, I believe that in 2026, they will be increasing it by another 700% in 1 year, not like the past 5 years. This year, they will be increasing it by another 700%. And you can imagine what these kind of charts will look like. So here we have EPS, and that, of course, also translates to, sheer free cash flow growth. So here we have free cash flow to the firm and also the margins that have been expanding throughout. So you have them at 16% here in 2019. Now they're approaching 40%. Because, well, why this, year range? Well, prior to 2019, they kept the same prices for, close to a century. Like FICO has been around for over 100 years, and they did not increase their prices for some reason. Well, 2018 came around, they started a software business, and they also started to abuse their pricing power, and this is the result. You might think that, well, 21, 22, 23 looks flat. Well, that is because rates were up by a lot, which pretty much, froze the housing market that affects mortgages and, the need for credit. So this is like the bottom of the cycle. And now you can see that start to accelerate. So, EPS growth, free cash flow growth, all the things you want to see. So how does it actually work? Before we get into how they're going to be increasing, their pricing power by another 700% this year. So I made this chart. It's not Gemini generated. So excuse me for how simple it is. But to the right, you have the consumer, right? You apply for a mortgage loan to the lender. It could be a bank. It could be, a similar entity. The bank then has to gather a credit report on the consumer, and they have to do that through 3 different credit bureaus, and those are Equifax, Experian, and TransUnion. So the 3 large credit bureaus in the US, because these guys have all the consumer data. What they don't have is the scoring model, the FICO scoring model. So they contact FICO to get the model. They apply it on the consumer data, send it back to the bank, and then the bank either approves the loan or they reject the loan. And this is called a tri-merge basis because, you have to go through all 3 different credit bureaus. It is pretty much standard for a mortgage in the US. That means that FICO, gets revenue from all 3 of them. Now, what's interesting here is that FICO, as I mentioned, they don't have any consumer data. All they do is they, come up with a scoring model, a mathematical model, that is proprietary. And then the credit bureaus use that, and you get a FICO score based on, the combination of the consumer data and the FICO model. So I hope I made that, simple to understand, because it is important, because this is how it has been working and how it continues to work. But just like the comment here mentioned, FICO has a complete monopoly. Something like third-party estimates put it at something like 95 to 99% of market share, which is the whole market. And you can't really raise prices by 700% in such a short amount of time without any kind of scrutiny, which is why the FHFA, with Bill Palt, as the comment here mentions, they started to target FICO for their pricing power. And the FHFA is the Federal Housing Finance Agency. But the angle that they had is that, well, people can't afford mortgages because FICO scores are too expensive. Like, it costs too much to pull a FICO score. Do you know how much a FICO score costs today? And then I'll ask you if that could be a reason why mortgages are too expensive. So today, pulling a FICO score costs $4.95. And you put that into context with...
there was something else that costs more in that equation.
That's the fixed price.
Okay.
So you put that into context when you're applying for like a $500,000 loan, several $1,000,000 loan. Is that $5 really the cause of mortgages being unaffordable? No. However, if you look at this chart, these guys also want the piece of the pie. So FICO, they have a fixed price, $4.95. So let's say $5, and then you multiply it by 3 for 3 credit bureaus, so $15. Okay, that's what it ultimately costs just for the FICO score. Then these guys put on their margin, which is often up to 5 times what it actually costs FICO. So let's say that the FICO score costs $5, they put on like $25, whatever. Still, it's still relatively low amounts of money in the context of millions of dollars potentially for a mortgage, right? Or 500,000 or 300,000 even. It's still minuscule. And also when you talk about closing costs, for agency or whatever, like there's so many different costs associated that the FICO score is not really the issue. I think they were targeted because of the pricing power. Now, what did FICO do that would allow them to increase their prices another 700%? Well, in October of last year, as a direct response, to the FHFA, they announced a new pricing model that they call a direct license model. So you have two options, as a lender. You can pay FICO $4.95, same price as today, flat fee upfront. And if the mortgage closes, FICO gets a $33 funded loan fee. So, $5 upfront and then $33 if the mortgage closes. And this is, a flat fee from FICO, or without any funded loan fee for mortgage closing, you can choose to pay $10. So already the $10 option is 100% increase from today. Or the other one, if a mortgage closes, means a 770% increase if the mortgage closes. And if it doesn't, it's still the same as it is today at $4.95 flat. So what it does is that it kind of cuts out these credit bureaus, right? Because the bank doesn't know. They just get a bill like, okay, pulling this FICO score costs this much, and then they give it to the consumer. But it doesn't say like, okay, the FICO score was $4.95. This credit bureau charged this much margin. This credit bureau charged this much. So what they do with this is that they go through, resellers. So the credit bureaus will still get, some money from the resellers that get the consumer data and make the FICO score, but it is a lot more transparent. So Bill Polt can't go at FICO like, hey, you're charging here several $100s or whatever. No, it is transparent. The score is $4.95 with a closing fee or $10 flat. So that's the bill that they get in separate. So they kind of checkmated the FHFA, while also at the very least increase their pricing power by another 100% in the short term. And still, as I mentioned, in the grand context of things, that 100% increase is still like very low. Like they could go several 100% more on top of that even after the increase, because we're talking single digit dollars, double digit dollars in the context of hundreds or millions of dollars when you are applying for a mortgage. So that was a lot of talk, but there's a problem, right? These guys are not happy because FICO has a competitor. That competitor is called Vantage Score. Do you know who owns Vantage Score? These very three, these three own the competitor. The ones that need to rely on FICO also own the competitor, which is Vantage Score. The problem with Vantage Score is that nobody uses it. That's why FICO has a undisruptable position, because these guys, let's say that the lender wants a FICO score, they get a FICO score and they get a Vantage Score. Do you know how much that costs? Free. They give it away for free, and still no one uses it. When when the competitor gives away their product for free and no one switches, that's when you have a systemic moat, like completely undisruptible. Like you can't even pay them to make them switch. And there's a good reason for that, right? Because FICO has been the golden standard for so long that their whole infrastructure, at the lenders is built on FICO. The whole market is built on FICO scores. So let's say that you have a 700 FICO score. That is not equivalent to 700 Vantage score. So the banks would have to re-underwrite all of their past loans to try to figure out, okay, we had this, 700 FICO. What's that equivalent in Vantage score? So they will have to re-underwrite all of their past loans to figure that out. And if they get the risk profile wrong, that could mean billions and billions and billions in defaults. So no one really wants to take that risk. Also, a lot of these banks, they securitize, the mortgages. I mean, I guess you've all seen The Big Short, where they make, securitizations of these, packages of mortgages, and then they sell them on the market or to Wall Street. Those are based on FICO score. If the bank comes to say, "Oh, this is a 700 Vantage score," Wall Street doesn't know what to do with that. They would demand a like heavy risk premium to even consider buying that. So the bank won't even make any money. So there's really no reason to change away from FICO, which is the golden standard. And even when it's completely free to switch, that is still too expensive. So with that said, let's look at the next slide here. So I hope that was a clear. Why can't I? There we go. Another thing, why this is completely unfair. Here are the operating margins for the scores business of FICO. This looks dramatic here, 21 to 22. This is 86 to 88% operating margin. What other business that does billions of dollars has 88% operating margins? No business. This is completely insane. This is like, for those gamers out there, this is what you would call broken, in the context of, completely unfair, unparalleled. This is completely broken. 88% operating margins. And in 2025, they report, a quarter display. So they already reported their 2025 scores grew 27%. And with this new pricing model, which by the way has gotten, really, really good feedback from the lenders, they're like really happy with that. It seems like this could start to accelerate explosively. So that's a short, summary of it. I have a full research report out on research.typeofcapital.com if you want to, read the details about FICO and also their software business. But this alone, like this price increase that they will start to see and that the lenders actually prefer, will mean a heavy acceleration from FICO. And also, we got an opportunity to buy it cheap because it's been trading like crazy. Because when you put up, compounding numbers like this, the stock tends to be pretty overvalued or expensive or both. But as someone mentioned in the comments, when the FHFA targeted FICO, the stock dropped harshly, like 33%. I was like, oh my God, it's my opportunity. And it's still trading in that range. So for me, fair value is around, $2,000 to $2,100. So I still believe it is undervalued. And I also believe that this is, one of the best performers in 2026, if I had to guess. So it's a brief overview of FICO and their scores business, which is completely undisruptible. When you talk about, wide moat, it doesn't become wider than FICO. Like no one can touch them. So yeah, it's an amazing company.
The operating margin that you show is only for the scores business.
Yes. Consolidated, it's above 60% for the whole business when you also account for software, which is around 30%, above 30%.
Okay. And I think last week you came. If you had to choose between FICO or S&P Global for 26.
But yeah,
You would
FICO
go
for sure.
FICO?
FICO for sure. S&P Global is more like it starts to accelerate in 2026, when you have the debt maturity walls, but those span several years. The thing with S&P Global is that they have a lot of, breadth to their business. They do a lot more stuff and things compound like individually, right? So you have the indices, you have the credit rating business, you have their software business. They're like all adjacent to each other but separate, and they take time to accelerate. FICO today, like there's nothing stopping them from just saying like, oh yeah, this $5 price to pull a FICO score, it's now 10, it's now 15, it's now 20. Like no one can stop them. Like they are trying to blame FICO for the poor housing market in the US, but it's a dead argument, because when you like the closing costs of like paying a realtor $2,000 closing fee, or paying that kind of fee, that like the FICO score in the grand scheme of things is tiny. So the room for expansion is massive. And they're not even standing still. Like they are doing a lot of stuff. They're trying to build scores for a lot more than just consumer credit. So they are still innovating, but their core product is still like insane. They're even doing stuff with AI. Like I cover it all on my Substack for those that want to read deeper. But yeah, I would say for 2026, FICO over S&P Global for sure. If I had to guess, like which one is gonna outperform. But then again, I don't track stock market prices, daily or monthly even. So what do I know? But if I had to guess, like the catalysts are lining up for FICO. It had a year to cool down, because I think it's up something like 27,000% since like over the past 15 years. I don't know what that is compounded, but something insane. So yeah, I understand that it took a breather, kind of needed that, because it was overvalued for so long. So we got a opportunity, and I think it's time to start to accelerate again.
For those that are wondering, it's trading at $1,600 dollars right now. And this was the
2,000
whole
for me. Yeah, that's the like
story
when
last
they
year.
started to get targeted. Yeah, exactly. And I mean, still like they're all 2025. They grew, scores for revenue by 27%. So it's not even like slow compound. They're like, no, that's pretty damn fast growth. At amazing margins, like unparalleled margins. I said
Yeah, not
15 minutes,
bad.
but my explanation was kind of long. But I had to explain how it works when you get a FICO score, to give you the context of why it's so undisruptible. Like, it's kind of funny that the only competitor to the FICO score are the credit bureaus that also need to rely on FICO. So it's kind of a funny dynamic there.
He does have a YouTube channel, which I'll pull up.
Yeah, should start posting more, huh? Start making some YouTube videos. Actually, Couch Investor is going to be on my YouTube channel shortly. He's going to share some 2026 picks with everyone. Roles reversed.
Indeed.
So
Hopefully non-painful ones like these. The pain pal.
PayPal. Someone actually reached out and wanted to do a PayPal interview yesterday, so I did that, and we talked, about
someone
PayPal
from
for about an
PayPal
hour.
or someone that covers the stock?
No. It
I
was,
would have been surprised if it's
content
PayPal.
create like it. I don't know exactly what they do. I think they're kind of business content creator kind of thing. But I never say no if someone wants to have me on. I don't care how many people you have. Like I'll do it. And PayPal, sure. We'll see with PayPal. I think brighter days are around the corner. But yeah, who knows with that one? Like
Yeah, exactly.
they could announce the cure for cancer and the stock would be down on the day.
Probably. I mean, they could, yeah, that's exactly. They could do that, and then suddenly Jamie Miller, CFO, comes out and says, yeah, but we are experiencing a softening in consumer spending. It's like, bam, we go down.
Yeah, and then when they see it like happening once, they go on Morgan Stanley next, say the same thing. Stocks drop further. Like, oh, we have another one with JP Morgan, say the same thing, also keeps going. Like, yeah. Do you believe that that is like kind of scripted on their end? Because obviously she knows what will happen when she says that, but she still goes on and says, yeah, looks pretty bad.
I mean,
Do you believe it's scripted?
if it is scripted, then I sure hope they did buy back more shares in the quarter.
Exactly.
But if they didn't, then they're just stupid. Because
Yeah, it is.
Why would you do it?
So I did a new calculation. So in my past articles, I said that when PayPal was trading at like 60 to 63, the stock price implies that the stock will decline by 4% every year. Now it's negative 8% compounded for the next 10 years. So if you believe that FICO will not be down by 8% in terms of
PayPal,
revenue, PayPal. What did you say?
FICO.
Sorry. So PayPal stock is priced for negative 8% growth each year for the next decade. If you don't believe that that will happen, then you agree that PayPal is under. By the way, another interesting topic that we kind of talked about briefly. Why do you think that they're not doing any insider transactions? Why isn't anyone purchasing the stock on the open market?
I mean, I don't know if you've seen my post, but that's a question that I have had myself. I mean, I understand that most of them are new to the company, like over the past 2.5 years. But still, would it hurt to just do a small buy on the public market just to send a positive message?
Yeah.
To me, no. But
which ties back to the whole thing, like they're not doing themselves any favors. It's kind of like implicitly trying to keep the stock price down, and I hope we will see when Q4 results come out in a couple of weeks here. Did they actually buy back a lot or not? Because if they didn't, then I'm like, okay, so what was the reason for all of this? Like what's happening here? So we'll see.
No,
but sorry, go ahead.
No, I mean, if they didn't, then they're not doing their job.
Yeah, maximizing shareholder returns. Basically, they're not doing that job properly. But for me, I don't really care. I'm not touching the position. I might be like, if we imagine going into the 40s, like how can you not? Like I will have to increase my position.
Okay, but here's the thing. Of course, we believe it is extremely undervalued. But what if the stock does go lower and then they get bought out at barely a premium to what we have? Then we are screwed.
Yeah, but you wouldn't accept such, like the board and the shareholders would not accept something like that if it's like way below fair intrinsic value. So it wouldn't happen. It's not like forced, It's not like just because you get a bid for the company that they have to sell it for that price.
No, let's say the stock dropped to $50, they get a bid $70. It is quite a premium on the stock price, but it's still a huge discount on what the company should be worth.
Yeah.
Maybe it does pass a vote because maybe the majority of shareholders will say, you know what, screw this thing.
I'm done with this stock. Fuck this. Yeah. I mean, it could happen. I mean, I would hope not at that price point. But the thing is, who's buying PayPal? There's a lot of regulations. Because now they are applying for a banking license. They process about a fifth of all digital transactions in the world. They have vaulted a third of all active cards in circulation. Like there's a lot of sensitivity to such a deal. So who would even buy PayPal?
What if they take it private? It's also not the greatest thing.
But they still have to buy the shares. So we'll get something. We might not get the 100+% returns that we are all expecting. But I mean, I mean, we're probably not going to lose money, but yeah, the opportunity cost would have been pretty bad if you
Severe,
have
yeah.
PayPal for the past 2-3 years, which I can start to see people lose patience. On X, mega bulls are like losing hope. And the average holding period for stocks is going down continuously. So I think for 2024 it was something like 8 months on average. I think 2025 it's like down to like half a year on average. And then imagine bag holding PayPal for 3 years, it did nothing. So I understand
3
people's
years of bull
frustration.
market.
Yeah. This is like when the stocks have been soaring, at least last year and throughout bits of 2024. But yeah, I mean, we'll see. I don't believe that we have to worry about the buyout, or if it's taken private. I think as they start to decrease, the share count, I think the stock will kind of soar. So, I mean,
Right,
we'll see.
that's what we hope, and that's why we bought it.
Yeah.
We just have to wait for the execution and a little bit more positivity from management when they get a microphone. But yeah, we'll see.
Yeah. All right. Thank you for having me on again. Sorry, took a bit longer than expected, but nice to see everyone in the chat again. F1 guy. Oh my god, I don't want that to be my title. Like,
The
I've covered that
Japanese
company
guy.
2 times. Yeah, I've been in Japan for a month. I'm already the Japanese guy. All right. Thank
All
you
right,
so much.
everyone.
I'm gonna drop. Oh, you're
Yeah,
closing the
I'm
stream.
also
Oh, okay. I'll say.
touching grass. So thank you all for joining, and we shall see each other in the next one. All the links will be also down in the description for Amir's channel, X, and Type F Capital Substack.
Check it out.
Adios.